to say that joining us here today to discuss the ETF landscape, including industry trends, portfolio construction ideas for Canadian investors, is Fidelity ETF strategist Vince Kraljevic. Great to see you, Vince. How are you doing?
I'm doing great. Thank you so much for having me.
Delighted to have you here. Happy Friday. Happy Friday to everyone joining us. And we'll send questions in over the next half hour or so. So let's begin with a little bit about exactly what you do every day. You are creating strategies ultimately for clients. Tell us a bit about what you're competing with. There are a lot of things out there in the markets. There are a lot of products. There are a lot of different ways of doing things. What are you sort of pushing against?
Yeah, so the biggest competitor that we typically come across, and it's most people still believe that all ETFs are passive. So whenever we talk about ETFs, it's always like, oh, what index are you tracking and things along those lines. But I was on your show recently and we talked about all the active ETFs that we're launching, right? So it's a wrapper, right? So we're product agnostic. We're launching ETF series on all of our active managers. So we're trying to dispel that, but I still walk into a lot of offices and the question is like, how's your ETF different from the S&P or the TSX? So that's probably the biggest competitor that we still come across.
Is the passive way of doing things.
Passive way of doing it. And again, it's a lot of people are Googling ETFs and they come up with ETFs.com, which is a US website. 95% of assets in the United States are passive, only 60 in Canada, right? Our
really?
Market, yeah, so like there's a material difference, but there's still that big misnomer that we're still trying to educate, and that's a big part of my job, like educating people about ETFs in general.
And passive at the moment has sort of a new twist because it's incredibly overweighted to the Mag 7.
Yes.
So there's a passive story. There's also arguably being too much overweight to something. Mm-hmm. Just talk us through that a little bit. Like what, again, would a more active approach do in light of the fact that there's a great weighting to the Mag 7 at the moment?
Yeah, so there's different ways of reconstituting or looking at an index and creating portfolios, right? So as you highlighted, the S&P 500 has a tremendous amount of concentration risk. The Mag 7 make up about a third, the top 10 make up almost 37-40%, top 5, 20. So there's just a lot of market cap weighting into a handful of names. And you've seen reports come out by Urian says based off of the S&P 500, it might return only 6% going forward. There is a report by a major US bank that said 3%.
Right.
And that kind of is true if all of your names have already been priced to perfection and you're stuck that way. So active managers try avoiding that concentration, finding diamonds in the rough. Our factor-based approach reconstitutes indices based off of what's worked in the past or historically or academically. So value, buying things below their intrinsic value tends to outperform in the long run. High quality companies, high return on invested capital, strong earnings, strong margins typically outperform, so on and so forth. We've talked about factors before. But what we've launched recently was marrying all the four factors because each one of these factors, you've seen the chart that comes in and, you should buy value at the beginning and you should buy momentum in the middle, quality. And trying to time factors it's a fool's errand sometimes, I believe. Like it's really hard to do. Like if you could perfectly time a factor, you'd be wealthy, but it's sometimes you get a lot of noise and this volatility.
Well, a volatility, and it's just you and I, you mentioned Urian, who we spoke with on Monday, spoke with you briefly on Monday, and at that point, a lot of the Mag 7 earnings sources have not come out, and there are lots of questions swirling around, are they overpriced, or what will earnings do, and even if they hit or miss or whatever, what will go on? But it speaks to, again, the concentration risk. Here we are on Friday, had a number of them come through.
6 of the 7, I believe.
6 of the 7, and some interesting reactions, some of which, again, had investors been looking through a lens perhaps of what you're describing right now, what would it be? Less exposed, essentially.
You would be less exposed. Yeah. Like the numbers that came out were phenomenal, right? Like the top line, most of them beat on the top, bottom line, strong margins, but little things like their cloud computing wasn't going to grow by 30, it was only going to grow by 25, or they're going to increase their capex on AI spending, just the range on the bottom. That caused kind of volatility in the prices. So over the week, if you look at the Mag 7, I think they're trading down, even though most of them bet on the top and bottom line. And if you reconstituted and underweighted them, probably wouldn't have suffered as badly.
So let's bring up slide 3. We're going to go through a couple of different slides that you provided with us, which are super helpful. But slide 3 takes a look at the downside protection. This is over a long period of time. But ultimately, take us through what being exposed to, as you say, many of the reconstituted parts of the S&P will give you on the upside, but then follow that on with the downside here.
Yeah, could we just go back to slide 1? I think it's a great.
Do you want to start with that first?
Start with slide 1 because it kind of explains what we did. So I think a lot of investors are familiar with our all-in-one suite.
Yes.
And our all-in-one suite is the typical balanced portfolio. But again, I've spoken with a lot of advisors, and a lot of advisors wanted to kind of tilt, or they had a different strategy or opinion. So we were helping them strategize on how to underweight Canada, overweight the United States, make these different decisions. So what we've done is we've taken out the regional portions of the all-in-one. So you have your Canadian sleeve, you have your US sleeve, you have your international sleeve. And just like the all-in-ones, we've just equally weighted the factors, right?
So you pulled these out of the all-in-one on the equity side.
On the equity side,
for investors who want, just the US equity piece.
Exactly.
For instance.
Yep. So if they want to reconstitute, so if they want 80% weight to the United States, 10% Canada international, they can do that. Right. And we just equally weighted all the 4 factors as we did in the all-in-one. So then to jump to the slide of the downside capture. So when you reconstitute and you equally weight the 4 factors, interesting things happen. So if you look in the bottom right corner with regards to correlation, we have a very high correlation with the S&P 500. It's almost 1. So as the S&P goes up, we go up. As the S&P goes down, we go down. But if you look at the top where it goes downside capture and upside capture, so we're not capturing 100% of the upside, we're capturing about 95, but that's kind of the S&P markets tend to kind of, there's times of, what's a nice way of saying it? Irrationality, right? So you add blockchain, you add artificial intelligence, and they rocket. And those wouldn't be captured in factors because they're not profitable companies, they're not generating earnings. So we don't capture all of the upside. But what happens is on the downside, we protect on the downside. So we only get about 80% of the downside capture. So if you look at the chart on the left, during the .com crisis, so
look at that.
Yep. So during the .com, if you weren't generating earnings, you had a non-meaningful PE, there was no return on invested capital, definitely weren't low volatility, so you wouldn't have screened. So we didn't get dragged down as much, but we recovered quickly because people started looking for quality, and then unfortunately got dragged down again because of the great financial crisis, but again, not as much, right? So by putting a fundamental approach on index construction, you can kind of avoid accidents.
We're jumping a bit, but if we can go back to the first slide, because just to look at the allocation of of the factors, essentially. So these are the pie charts.
Yes.
So you've got, so that is the all Canadian, and then we've been talking a bit more about the all American, and then there's the all international for those that want that kind of exposure. Striking how evenly between high quality value, momentum, and low vol all of them are. I mean, I'm sure you didn't just drop them in the bucket and just go, okay, 25% in each. What's behind this?
Honestly, you are really close to that.
What drove you to that? Because that...
As I alluded to before, each one of these factors technically works at a different part of the business cycle, and it's very hard to try timing them. So we just know that if you factor investing in a long period of time, as you saw from 1999, generates outperformance. But trying to figure out how to tilt is extremely difficult to do. So I call it a business cycle neutral portfolio.
So you're not making a call on the business cycle here.
We are not. We're business cycle neutral, right? So in the early part of the business cycle, in terms of factors that work, is size and value. In the mid cycle, it's momentum. In late cycle, quality, and in recessionary, low volatility. But we can go through it quickly. It might take forever, and each one of those 4 factors generate outperformance during times of when they're not really working. They're just getting market-like returns. So you just have to hit a few times. You don't have to be winning all the time, making dramatic bets.
That's fascinating. Okay, let's take a look at the 4th slide. This takes a look just more deeply at some of the exposures to the S&P, but versus, or sorry, how the fund fits versus what the S&P has in terms of the different sectors themselves. So if you go down the information technology, I mean, so less there, Love looking at the comm services almost at the bottom.
Yep.
What's that? I mean, that is meaningfully less, which would have been useful this past week, perhaps.
Would have been useful since, so the Mag 7 hit an all-time high in July 10th, 11th, and they still have not recovered to their all-time high. So the S&P 500 is creating new all-time highs without the help of the Mag 7. And those are primarily located in information technology and consumer services. Actually, since that time, those were the only categories generating negative returns. Practically all the other sectors have generated positive returns. Financials, real estate, industrials, I believe, created double-digit returns.
So industrials, you're double what
Yeah,
the
yeah.
S&P.
So our sector weightings have worked tremendously well since the all-time high of the Mag 7. And communication services, again, through our screening process, right, we are looking for value companies. So companies that trade at a low PE, typically they don't. We're looking for high-quality companies, high return on invested capital. Some in that category, there are some in that category. But just the way that we're reconstituting the index, we're creating a different index, so to speak. So as opposed to having 501 names, we're only having 246 based off of our screening criteria. And it's funny that it's picking up on trends that we talk about just through the algorithms that they're running, right? Just through the screening process.
What trends?
So if you look at information technology comm services, the overconcentration, like it's slowing momentum, so it's kind of diversifying away from that. And if you look at the overweights to utilities and industrials, it's kind of capturing people reinvesting into onshoring, decarbonization trends, things along those lines. Because if you want artificial intelligence, 3 of the Magnificent 7 have signed contracts with nuclear power plants, right? So if you do need that, if you want artificial intelligence, there's a whole bunch of back end, like bricks and mortar, that you do have to build out for that.
That's
really
that build. So it's capturing some of those trends, as you say, that we talk about all the time. One thing we haven't talked about at all, which is sort of shocking, is not the election. But is the macro picture and really the interest rate story. A lot of the Mag 7 will say are somewhat agnostic to whether interest rates go up or down. So we kind of know that. But this strategy, I don't know, maybe it's a Mag 7 strategy versus macro. But where does the macro picture of we think falling rates from here fits in? Is it just a nice tailwind? Or is there something more profound?
Yeah, so falling interest rates, they definitely, if you look back at history, falling interest rates help equities, right? So it just is a nice tailwind, helps with PE ratios. But when you start getting down to the nitty and gritty, it actually starts helping small cap and mid cap a lot more. So our regionals look at the Russell 1000, so it's not just the top 500, it's top 1,000 companies. So we can screen at the bottom part, like 900, 800, 900. And typically those are helped just because they're more interest rate sensitive.
Yes.
Right? Okay. And especially small caps, things along those lines. If I think it was Apple did a bond 2 years ago for 40 years. It was the longest bond issued. Yeah. Whereas small mid caps, 3 to 5 years. So or floating rates, so they're a lot more sensitive. So these changes in interest rates definitely help them a lot more.
Okay, and so there's just a reflective. There's a reflectiveness. The numbers and the names and also the sectors that we looked at there are all as of I think September 30th of this year.
30th, yep.
Yeah. But as we get further into that, maybe there's more to ask. So what if, you said some of it there, what if there is more of this normalization / rotation? You're there to capture it, it sounds like. You're essentially preparing for that? I mean, is it too far to say that there's going to be a rotation out of some of the Mag 7 into others? We've seen some of it. Yeah. Are you preparing for more?
I think, so to speak, yes. If you look at Q3, and it's very funny. If you look at the sectors, so technology was flat for Q3, but if you looked at real estate and financials, which are cyclical, and utilities and consumer staples, which are technically defensive, they outperformed substantially, right? And again, those two groupings, cyclical and defensive, shouldn't be working at the same time, but it seems like everything but tech and Mag 7 are working if this trend continues, right? So. There's definitely tailwinds, and especially if you're looking at the top 10 companies are making 35 or 40% of the market cap of the S&P 500. The question is, are these 10 going to become 60?
Right.
Or have they been fully priced and will grow into their earnings, right? So again, they've
still valuable companies.
Still valuable companies.
In many different ways.
And if you look back 2 years ago, they were generating 60% earnings growth when the other 493 were having negative earnings growth. So like substantial earnings, but now their earnings growth isn't that, like it is still higher. It's like, let's call it 20% higher, but their multiples are that much higher. So
are they growth stocks?
They're definitely growing their earnings.
Yes, I know, that was a good dodge.
Right?
Yeah.
But it's like, are they going to grow into those prices?
Okay.
Yeah.
Okay. Are they growth stocks?
Yeah,
he's like, next question, please. That's fine. Yeah. That's really interesting, actually. So if we go back to sort of the top 10 there, can we go back to that slide, number 4, one more time? Again, this is end of September, but you don't have all of the Mag 7 in the top 7, in the top 10, which is what you've been discussing. But I wonder if you, again, can kind of talk around the outsides of some of the others.
Yeah, so of course, it's very common that we show the top 10 of portfolios, but the very first question that people ask me is like, well, what's your weighting to the Magnificent 7? So this is why it's the top 10 plus 3.
Okay. Oh, interesting. Okay. Top 10 plus 3.
So we do have weightings to Apple, Microsoft, Nvidia, and Amazon. Like they are in the top 10. And again, Apple is a high quality company trading at fair valuations. So it's in all of the portfolios, but you can see that we've re-weighted it. So we have an underweight of about 1.8% to Microsoft, 1.4%, and Nvidia, 2.4%. You'll notice that it's not low vol. So we do have exposure to them because, again, to your point, they are quality companies, right? It's just, should they be repriced a little bit? And then if you look outside of the top 10, Alphabet, Meta, and Tesla don't even break into the top 10. We don't even have a weighting.
Tesla's not, yeah.
We don't even have a weighting to Tesla. Just it has not screened in an attractive manner.
So that was very diplomatic. I like the way you said that. It's really interesting. This has been an interesting week. Next week is going to be a very interesting week as well. Again, I guess just kind of coming back to the central theme of what a rather neutral stance on the business cycle itself, but perhaps that extends to just a diverse way of looking at things to march through difficult times. What do you say to those investors who've held on a little bit this week? It's been a little bit of a road.
Yeah.
Next week will be too.
Yeah, next week's probably going to be quite a road. But I think on your show I said, in times of volatility, diversification is your friend. So right after that, you had the yen carry trade unwind. Fixed income, the 10-year went from about 4.5 down to 3.6. Now it's back up to, I think last time I saw 4.3. But I actually overlaid our all equity portfolio with our global fixed income portfolio, and it perfectly yin and yang. So when the market dropped, yields dropped, so it kind of balanced each other out. So that's why a diversified approach through these volatile times, and everything came back, right? So it just smooths out that cycle. And if you start looking at what's happening next week, so Tuesday you have the election, and if you look back at history, it doesn't really, you've had a number of people that have come on the show saying, you kind of have to look through the election because in our analysis, we've looked at the election year. So typically the election year generates about 10, 11%, broadly in line with all years. This year was actually a great year. It's, I think,
as in the year, which we're almost at the end of.
Yeah. And then next year, again, the year after the election, 10 to 11%. So there's not really this volatility. And if you compare ourselves to 2016, 2020, the most comparable, because you have the same candidate running, those years were above average, right? So hopefully the same holds true. We don't know, but you have to look through it. But one thing that is consistent through like segments of the market that do well during an election is, again, small and mid cap, right? Okay. So usually when politicians are on campaign trails, they're making promises. Mm-hmm. They're making promises to help small business owners, small businesses. Any onshoring or tariffs usually helps local producers. So all this talk by both of them kind of seem that, again, it will probably help small mid cap, which we do have a way to, or a kind of a preference to in our regionals.
Plus lowering interest rates, but yes.
Plus lowering interest rates. So you have the two tailwinds helping, right? So there's two things that are kind of helping it along. And again, people are talking about a divided Congress, but helping small businesses and mid-cap companies is something I think both sides would agree on. Everything else might be gridlock, but helping Americans would probably be politically appeasing to both sides.
So we've taken a look at the All-American Equity in some detail. There are the other funds themselves as well. Just tell us a little bit, okay, Canadian investors making Canadian bucks. Just tell us a little bit about the All-American and, you know, what you want to, is it hedged? Is it not hedged?
Yeah, so great question. So with regards to all of the regionals, they're not hedged.
They're
right?
not hedged.
And
okay. The regionals being Canadian, All-American, and international.
All international,
okay.
Yeah. So they're unhedged, which a lot of people like in light of the fact that, you know, you've listened to our global asset allocation team, things along those lines. We're decreasing interest rates, the Fed's decreasing, maybe stalling, maybe lowering a bit. So there's definitely downward pressure on the Canadian dollar, which would be a tailwind for the portfolio on top of all the other things that we chatted about.
Okay, fantastic. Anything that you want to say just sort of in terms of the factors themselves? Like when we go into quality, there's a big discussion about mid caps, maybe small caps as well, but just the idea that they've been able to get themselves into shape over the course of the last few years. It's been rough knowing that interest rates have gone up so high for a smaller company, but a lot of the ones that have survived and are still standing are in better shape and are stronger. Is there anything to sort of talk about on the quality side of things? Are you looking at slightly different things when you're going through the lens of a factor? Are you finding new things about companies?
Well, that's an interesting question. So yeah, as you're looking through, using a factor-based approach to look at stocks, interesting things pop up, like the same stock might be quality and value and things along those lines.
Right.
But with how everything has transpired in terms of quality, a lot of the large caps and mid caps have kind of like pushed out their debt walls. So there was this big fear about this debt wall coming, and a lot of companies were able to push that out. And the other interesting thing with regards to companies in the United States, the number of zombie companies has actually dropped.
Yeah.
Right.
There's some strength in
there's some strength, especially for the smaller companies that, you know, they're domestically oriented and their earnings margins are actually holding up. So for all the doomsayers over the last 2 years, it looks like the resilience of the American consumer and the stock market has been phenomenal, to say the least.
And so within low vol, for instance, you know, that's not always where you'd find the Mag 7, for instance, but you have allocations to different parts, different other sectors within the S&P. Just take us through what is low vol, because I do feel like even the sectors are changing a little bit. I mean, you mentioned utilities and industrials are now sort of a play on reshoring, on maybe new types of energy as well. Like there's some changing dynamics there. How does that get reflected again in the factors?
Definitely changing dynamics. But the other thing is with regards to so we look at three things in our low vol. So it's own price volatility, it's beta, so it's volatility relative to the index. But we also look at earning stability. Right? So the funny thing is, a lot of the Mag 7 do have earning stability, right? Like they are becoming like the new blue chips, right? Like if you look, when you got your first iPhone, it was like, wow, I got it. Now it's just like, I need to do dishwasher. It's just like one of those things that
it's adorable.
And it used to be, Windows 95's coming out, right? And like Rolling Stones are promoting it, right? Now it's just SaaS, right? You're just paying a monthly thing, it comes out of your account, you're not even noticing it. So it's like a hydro bill right now, right? So
it's a utility in that way.
It's effectively utility at that point. So it's kind of being treated as utility in some senses in our factors because we look at earning stability. So
that's really interesting. The sectors, I mean, sectors always change with sort of new mini industrial revolutions. They do change and they move around a little bit. But this is one of those moments, would you say?
Well, yeah. Well, with artificial intelligence, we don't really know what's going to happen, right? Like they're saying that the next big thing is an app, right? So it's not this
what we're talking.
Yeah, what's the new killer app? And you know, back in the day, Rogers and Bell didn't compete, right? One was your telephone, one was your TV. But now they're directly competing. And you know, if you look at some of the Mag 7, one was a delivery system, one was your office, but now they're all competing in cloud computing, right? So they're starting to merge, and so there is a convergence of sorts, and it's an interesting time to be alive. Let's say it like that.
Yeah, it's an interesting time to be alive, but it's also an interesting time probably to be very active.
To be having an active approach, right? Like just being hands off, following the passive, and this is the conversation, right? Like. In Canada, Nortel went from 0 to 1/3 of the TSX, and in passive, you're just tracking that back down. You're not reconstituting it or going like, well, it's showing negative momentum, maybe we should boot it out. And likewise with the Magnificent 7, they went from, you know, 15 to 30, right? Are they going to be 30 to 45, or is it going to normalize? Either they stay the same and there's opportunities elsewhere. And that's when all the numbers that come out, like Urian and the bank, like 3 to 6 for the S&P 500. But there's definitely ways of generating alpha outside of that by not being handcuffed to what's passive or what the 500 companies are, like looking at through a fundamental approach.
Fantastic to have you take us through all of this and some of the slides that you helped us understand, particularly in the all-American equity sleeve